Gautam Duggad is as well joining in on the show from Motilal Oswal. Good to have you on board. Gautam, let's get in your take on the entire IT sector. Given the fact that you do have a number of tailwinds with the fact that attrition is tapering, you've got the currency weakness as well as client spend sustaining. Do you believe that we are likely to see the underperformance within this sector now come to a halt? Is there long-term potential within IT, and if so, where?
Yeah, hi, good afternoon. Thanks for having me. I concur with that view that this is a good time to add IT names. Variety of reasons. Obviously, the impact or the much feared impact of the slowdown / recession in US and Europe has not yet been felt in the numbers. In fact, in the last 6 months, a couple of companies have raised their guidance. And as you pointed out, at the margin, the supply pressures on hiring has moderated, which obviously will reflect in the sequential margin improvement that you will see. Secondly, many of these stocks have rallied 20-30% from their respective lows, but they're still 15-20% away from their respective 52-week highs. In the meanwhile, the market has obviously, as we all know, reached new highs. Second, fundamentally, IT over the last 2 decades have handled and negotiated many macro crises brilliantly. Whether it was Y2K or 9/11 or GFC, taper tantrum, COVID. So even if there is an elevated pressure on order book because of few quarters of a slowdown or recession, I think that would be the time to add IT stock and not sell. We have a overweight position on IT for last 3 years in our model portfolio. At the margin in the last 3 quarters, we had completely removed mid-cap stocks because mid-cap IT was trading at a very high and unsustainable premium in our view to large cap IT. Our preference and bias clearly remains towards large cap, where the cash flow payout and of course the free cash flow conversion matrices remains rock solid, and stocks are available 20-25% still below their respective highs. So this continues to remain an overweight stance for us.
Gautam, where within banks are you finding preference? Is it the PSBs which have performed much better in terms of just stocks year to date, or do you think it's now the bottom-up story is the banks which haven't participated in the, in the rally, they're likely to do better?
So Aisha, we have overweight stance on financials, and this remains our single largest overweight in the model portfolio. A year back, we had, or rather a year and a half back, we had significantly increased the overweight on PSU Banks. In fact, today, the single largest overweight across our model portfolio is on PSU Banks. We have about 7% allocation to PSU Banks in our model portfolio since more than a year now. We have SBI and BOB. As far as PSU Banks are concerned, we haven't gone below that so far. We also have private banks, but we still feel that in the near term, there could be some more catch-up which can continue to happen on valuations of PSU Banks as a pack. Because private bank trade has played out in the last 12-18 months, and private banks numbers have been on an improving trajectory for last 3 years already. Numbers of PSU banks have started improving only 2-3 quarters back, and we clearly see more room for them to go ahead, whether it is on credit growth or on credit cost. And valuations, despite the recent run-up, most of them are still below 0.8. Only 1 or 2 PSU banks have crossed one-time price to book. So while we like private banks, we see that there is some more alpha which can be had from the PSU bank trade. Overall, as far as numbers are concerned, we have seen that in the last 5 years itself, the financials which are part of the Nifty, their profits have gone up almost 5x from 45,000 crores in 2018 to about 2.1 trillion this year in 2023. And we're expecting another 20% growth in FY24 on that elevated base. So we continue to remain positive on financials as a pack. Within that, our preference as of now, as is reflected in our model portfolio, remains with PSU banks.
Given the fact that you prefer PSU banking names and you have 7% allocated to the entire financial space, just wanted to understand, why have you limited yourself to just SBI and Bank of Baroda? What is stopping you to look at the mid-tier banks as well? Are you waiting for a sustained improvement in earnings?
No, not necessarily. You cannot have all the stocks in the model portfolio, right? We prefer a strategy where our biases and preferences are reflected in a very concentrated way in few stocks rather than scattering the weight thin around multiple stocks. So we have 5% allocation to SBI, 2% to Bank of Baroda. Rest of the names in PSU Bank, if you look at them, they are more or less a trading kind of a bets, where you have to be very swift as far as entry and exit is concerned. In SBI and BOB, we think we can take a slightly more longer term view, given the way numbers and specifically ROEs are panning out. Most of these banks, whether it is SBI or BOB or even some other names, they are sitting on 70 to 80% of provisioning coverage ratio now. And some of them are almost about to hit 15, 16% ROE as well. But as far as the allocation goes, we are comfortable right now with these two names.
Gautam, we interacted with the management of BHEL earlier this morning, and they were pretty confident that Capex is picking up all around and that the on-ground situation as well is looking quite good. And those seem to be the sound bites that we're getting from a number of corporates within this sector. How are you looking at playing this entire theme?
Yeah, so Capex has been a theme for a long period of time now. I mean, there is no year when people have not stopped talking about Capex as a theme. The reflection in numbers, however, has started happening only in the recent past. And even here, the numbers are very, very patchy. You know, you have few subsectors where you can clearly feel that Capex is picking up. But if you look at it at a system-wide level, if you go by the RBI data, the seasonally adjusted capacity utilization is still around 74.3, which is not what you will call as a big Capex boom which is happening. So my way is you take a very, again, concentrated exposure towards various subsegments. So for example, we have exposure to cement. We have it towards capital goods through L&T, a big overweight on L&T. We have big overweight on Ultratech. And then we are also using real estate as also a play on Capex, because end of the day, household Capex and central government Capex, state government Capex, and some of the other leasing developments that we've heard, real estate also allows an entry, a vehicle to play the Capex theme. As far as the more, some of these recently buzzing themes are concerned, things like defense, things like railway Capex, currently we don't have coverage on those names. So I'll steer clear of making comments on them, but they've done well too in the last 12, 18 months. So unless somebody has an exposure to those themes, entering it now when the stocks have already run up 3 to 4x, I think the risk reward will incrementally look slightly less favorable, even though the broader theme of Capex will play out over the next couple of years.
Well, Gautam, just wanted to pan out and talk a bit about the index level itself. The valuation at the index level is still above the long-term average, right? Whether you look at the 12-month trailing data, which is 17% higher than its long-term average, or even the forward earnings, which is still at 8 to 9% premium, and the market capitalization to GDP ratio too is at FY22 high. Do you expect the upside at the index level to be capped?
Yeah, so we had a similar view prevailing a year back when we were thinking about 2022 outlook, because market had run ahead of the earnings, and it was important for the market to, consolidate and allow the earnings to catch up. Now, what has happened in 2022 is in the first half, you saw a big drawdown towards 15,000, and then we have recouped all the losses. And I think now we are trading 5-6% higher for the year. So broadly, I will still call it as a flattish market. But what is happening is because the world has fallen 15, 20, 25%, India is standing out as a relative outperform. Going forward, the situation can reverse to an extent that while on an absolute basis, we may not do much. We may, consolidate in this band, maybe plus minus 5%. But relatively, it may happen that some of those markets in the emerging market world, which have collapsed and are now trading at 9-10 P, they might see some tactical bounce back. And therefore, from a short-term point of view, in the next 6-9 months, we may possibly underperform without losing much on an absolute basis. As far as valuations are concerned, right now we are trading somewhere about 20.5 to 21 one-year forward earnings, which is not too exorbitantly expensive, I would say, because the long period average itself is now 19.5 to 20. Because if you had looked at the same data 2 years back, on a 10-year basis, the long period average used to be 18.5. But what has happened incrementally in the index in the last 3 years is a lot of these stocks with high P and sectors which inherently enjoy higher Ps, they have entered the index. And therefore, the index P itself on a 10-year basis has gone up a little bit. So I won't call current valuations are exorbitantly expensive, and certainly they're not cheap. So in such cases, typically we have seen in the past that market consolidates, and broadly tracks the earnings growth, which it anyways has been. If you look at the last 3 years, Nifty earnings are up somewhere about 90% from FY20 to FY23, from 3.5 trillion to about 6.7 trillion. And our markets have given return broadly in line with the underlying earnings growth after doing nothing for almost 10 years when earnings also were flat. 6.5% earnings CAGR we had seen between 2010 to 20, and markets also gave you 8.5% CAGR. So market, despite all the noise around macro, geopolitical headwinds, central bank commentary, has broadly respected the underlying earnings growth pattern. And I think that will continue.
The take coming in on the markets and at the index level that while the earnings growth is likely to continue, valuations are not exorbitant, but we might underperform on a relative basis given what's been happening across the world. Thank you, Gautam, for joining us today. Really appreciate your time.